Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. We're coming into the final minutes of today's trading session on this Friday, September 26th. And as you can see here from this daily candle, we have a spinning top on the diamonds on lower volume. Now we have a conflict down below between the stochastic, which is still going down, and the CCI, which is now pivoted higher with a buy signal. So it's going to be an interesting week next week as we come into the final trading week of the third quarter of 2025. I think they may try to push the market up to get a strong close for the quarter. Therefore, I lean more towards the CCI because that is a cross over the momentum line, and that is a buy signal for those who are momentum traders. That momentum line is also known as the zero line. So I think we'll go a little bit higher early in the week and then possibly sell off. So I'm just going to go with a slight upside target here to 463.95. Talking a little bit over 100 points on the Dow for that to hit right there. Looking at IWM, you'll see that we have a similar case here where the CCI is crossing over the zero line or the momentum line down there. So we generally get 2 to 4 days of movement in the direction across. So I'm going a little bit higher on IWM to 243.06. Actually, I'll get rid of the pennies there. Just put 243 there for you so we have that in place. Looking at the Qs, that's the NASDAQ market. Very interesting thing has happened here where we had the number 8 fan line, believe it or not, going almost vertical. That broke earlier in the week. We went right to the next fan line in the sequence, which is what you usually see. And now we're breaching this number 7 fan line. And we have a hammer yesterday, slight hammer today. And so I think we'll go a little bit higher. I'm going to do a two-parter on the Qs. I think we could go a little bit higher. I'll round that up to 600 right there. And then I think we could pull back and start the month of October with a pivot lower. And I'm going to put that downside target right to that fan line. So again, to reiterate, 600 on the Qs on the upside. And then that's 594.18. I'm going to keep the pennies in there because that's right where that number 6 fan line is. Looking at SPY, you can see here that we have another pivot to the upside, cross over the zero line on the CCI. I'm going just a little bit higher there to 664 even. So 664 on the SPY. And the main reason I have upside targets this week is because I was watching the VIX and we have a very well pronounced bearish engulfing candle here. And there is absolutely no shadow at the bottom of that candle. So it looks like the VIX is getting pounced on pretty hard. And we're almost at that point where the VIX is going to cross down below the zero line. That bearish engulfing candle is very significant when it's engulfing more than just the previous candle. And so we covered this on the Technical Tuesday educational video. I'll put a link to that in the description box below so that you can get an eye on that and really understand how we're working bullish engulfing, bearish engulfing. Some of the other patterns are hammers, shooting stars, and we'll continue to give you that education each and every Tuesday. So here's the closing bell, again, for this Friday, September 26th. And there it is. Now, the Dow just closed up over 300 points. And what I find most interesting is that the market was up on fairly positive economic data. You can see here this morning, the personal income month over month is up slightly to 0.4%. And not only that, but the personal spending is up by 0.1% to 0.6%, which is slightly higher than the forecast of 0.5%. So that gave the market a jolt in the arm today. And while personal spending is up and personal income is up, this is where it gets a little confusing, because if you look at what Moody's put out recently, a third of the U.S. economy is already in a recession or at high risk, and another third is stagnating. Right now, in addition to that, if you take a look at this chart down here below, high-income Americans are behind roughly half of all U.S. consumer spending. So what's happening to the rest of the folks that are not high-income Americans? Well, they're suffering right now. And as you can see, if you check the data, we still have inflation as one of the biggest threats. But as the Fed lowered rates last week, they don't seem to be too concerned about inflation or what they're doing to invite inflation into the economy. They're more focused on jobs and job creation. And so when you look at some of the other economic data, this is, again, very interesting coming from Bloomberg, where bank reserves at the Fed fall below $3 trillion amid liquidity drain. And so what this means is that we have account holders are pulling money out of their savings accounts, whether or not they're using that to buy groceries or to help with the cost of living, we don't know. But when you look at the data that came out through the Forex factory, spending is up and income is slightly up. So it seems like Americans, or most Americans, are treating their personal finances just like the U.S. government is. They just spend, spend, spend. And so, if they were not spending so much, maybe they'd be putting more money into their savings accounts and helping to build their retirement plans, or at least going out there, taking some of that money and buying silver. And that's exactly what we are seeing. If you look at the silver market, we have SLV was up very nicely today, up over 2%. And for those who follow me on my SLV trades, I took some of my position off right here and on this pivot, and I could not stand being out of the market, so I wound up buying it back the very next day on this breakout. And so what happened was a reverse parlay, right? I gave some of the shares that I accumulated in the last round, I gave that back, but I'm still back in to 100% of my SLV position. And I did the same thing with AG, and I wasn't trying to get cute with this at all, but I sold 100% of my AG position out, and it looked good the very next day. It looked even better the day after that, but I bought it all back on that bullish harami. Remember what a bullish harami is? It's a small body candle that falls within the body of the previous red candle. And not only is that a bullish harami, but it is also doubling as a hammer candle. A hammer candle is found at the end of a downward leg. That's a very small 3-day downward leg. And it has a small body with a shadow that's at least 1.5 times the length of the body. So I bought it all back there for a little bit less than what I had sold it for on this green candle. And I'm back into 100% of my first majestic silver position. I'm just throwing that out there, telling you what I'm doing. I obviously can't tell you how to trade, what to do with your money. I cannot advise you in any way, shape, or form that way, but I can tell you exactly what I'm doing. So that's with silver. Now, if you take a look at CVX, I want to show you a couple of stocks here that we covered on the midweek report. CVX was pivoting right here, and on Wednesday I did a 2-part forecast where I said that I believe that CVX, according to the charts, will go up to 160, 113 and then pivot lower to 158.51. Now remember, this is Wednesday right here when we did the rapid fire stock analysis session. And oh, by the way, if you're interested in plugging into that, we have a 2-week free membership that is no obligation, no credit card, none of that needed. You just plug right in, and you can either participate live or you could listen to the recording, and you can get all my forecasts. Now, I went over 50 stocks in 60 minutes, with CVX being one of them. So the upside target is hit, and look what we have here, a bearish harami candle. What is a bearish harami? Well, that's the opposite of a bullish harami. It's a small body candle that falls within the body of the previous green candle. Now, what we have here is a break in this green. So we had a stale green light. Today's the first red candle, after the last 4 days. So I think CVX could start to pull back to 158.51. On another energy stock, which is Devon Energy Corp, I had an upside target that hit today. That upside target was set at 37, and it hit perfectly, and the volume is increasing. Now, I'm focusing a lot of my attention in energy, gas, and oil, and also the drillers, and here's why. If you're keeping an eye on what's happening with Wexit Watch, this is a big deal here, because it looks as though Alberta struck a bold deal with the U.S. to secure their exports and maintain their revenue stream through the oil supply that they would be providing to the U.S. Now, Ottawa is most likely losing their minds over this because Alberta is their main revenue stream as far as oil production. Now, keep an eye on this one. I follow Wexit Watch. It's a small little channel on YouTube. And while I think it's going to take a good long time before anything happens with regard to Alberta pulling away from Ottawa and becoming their own sovereign nation, it's most likely going to add some volatility to the oil market. So for the option traders out there, DVN is something that I'm looking at. CVX, you could even look at OIH. Right, OIH is in a really nice upward sloping channel. Just kind of giving you some ideas here for the option traders. Now it's at the upper end of this channel, but the volatility premium is strong enough for you to be doing some spreads and helping you, again, maintain comfortable positions. And so speaking of positions, we have another trade of the week. This week, we put a trade publication out on OKLO, where our members went out and bought the January 100 puts for $13.30. Now, before I get into the details here, let me first state that this trade publication page is for educational purposes only. I'm basically showing you the signals that showed up on the day this publication went out and what's happening with that stock as of today. So members went out, bought those puts for $13.30. We put a $4 risk per share on that, or a $400 risk per option. And if you have any questions about how we're managing risk on trades such as this, feel free to put those questions into the comments field below, and I'll do my best to answer those questions for you. And so that went out, and as of yesterday, those $100 puts were trading 19, so they were up 42.8%, almost 43%. Now let's take a look at the charts. Again, on the 24th, which was right here, we saw this massive bearish engulfing candle. Remember what that bearish engulfing candle represents. It's when the sellers are taking over control from the buyers. So if you take out your trading checklist, you'll know that that is the first thing that we look at is the type of candle. So that was bearish. In addition to that, it was the first red candle that showed up after a long stretch of green known as the stale green light. And at the time when the publication went out, I recorded a video and I put a target on that stock for 110. Now, I certainly did not expect that to hit the very next day, but in fact, that's exactly what happened. And you can see here, it gapped down. Today, it traded down another 7%. And so when I'm looking at that and I'm looking at a trade, I'm thinking, do I take those profits or do I let it run? One of the first things I look at is that drop in volume. Now, the oscillators are still going down, but when you have almost a 43% profit in a stock, you have to make a move to protect that profit. Why? Well, in a situation like this, you have a gap above the market now, and there is a very good chance that that stock will move back up to fill the gap. And then once that happens, we could see a reversal from that point. So I always tell our members that you cannot lose money taking profits. There's always going to be another trade down the road. You could take your profits, bank it, and save it for another trade when these publications go out. And so this was the trade of the week. I'm very happy about that. Now, one of the other things I want to mention with regard to those who have never subscribed to the Sticky Trade channel or have never been a member of Sticky Trades, we pride ourselves on being able to teach the general public how to read the charts. And if you go back and look at the diamond chart that we have here, you could see these diagonal lines that I have. I'll try to highlight some of these. You could see that there's these diagonal lines. These are my price targets. Here was a downside target it hit. Here was a two-parter. That one hit. This one hit. This one took a while but then hit. This one also hit. This target here, which is my longer-term downside target, is 368.12. That's obviously going to take a while, but we have another downside target down here. Now, why am I even showing you the downside targets after I just gave you a short-term upside target? Because as option traders, we are trading the swings. We're not investors. We're not buy and hold. We don't buy something, forget about it, and hope with our fingers crossed that it's going to work out. If the upside target hits, and then we come into October, and then all of a sudden October is looking more bearish than bullish, then we're going to start adding negative delta positions or adding puts or bearish positions to our account with the focus on these targets to hit. And this is how we trade. So if you want to learn how to read the charts, you don't even need any money in a brokerage account to learn. You could paper trade. And a lot of the brokers have a setting on their platforms so that you could practice trade without using any money. And, there's absolutely no risk when you do that. So I've always told people, practice, practice, practice. Look at the charts. Look at lots of charts. Forecast your own price targets. Look at the bullish and bearish engulfing candles, haramis, shooting stars, hammers, you name it. We teach it. And these are high probability candle patterns. So again, go back to Technical Tuesday. Look at all the videos. They're free. They're very short. They're 8 to 12 minutes long. And I talk about those as being your weekly technical analysis vitamin, if you will. And so that's what we put out to the public. I hope you like it. I also found through Google Analytics that the majority of people that watch these videos are still not subscribed. That's very interesting. But if you're not yet subscribed and you like the content, you want to help us grow this channel, please hit the subscribe button, hit the like button, make some comments down there. We love that. And make sure you hit the notification bell so that you'll be notified when the next educational video goes out. So thank you so much. Have a great weekend. We'll talk to you next time. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.